Thanks, Starty here. My name is Liam Kelly. I'm the editorial manager of Crypto Briefing, a crypto-specific publication covering all things fintech, DeFi, and of course, crypto. I'm joined by Hugh Karp, founder of Nexus Mutual, and Yaron Velner, founder of B.Protocol. So we have just 30 minutes, and so I'd like to dive right in. Perhaps, Hugh, you can start. What would be maybe the layman's explanation for Nexus Mutual, and what would be the elevator pitch for what Nexus Mutual is trying to do?
Yeah, just sure. So we're like the community insurance alternative. Basically, it's like a group of community members pooling money together and then deciding which risks they cover and deciding which claims they pay and those types of things. So it's really community-based coverage, like how in kind of insurance started like hundreds and hundreds of years ago. Actually, it's kind of that's kind of what we're bringing back with new tech.
Okay, and Yaron, what's the pitch for B.Protocol?
Yeah, so B.Protocol is a new DeFi primitive which implements backstop. So all DeFi platforms, most of them like MakerDAO, Compound, all the lending platforms heavily rely on liquidations to remain solvent. And they offer a lot of incentives for liquidations, for liquidators to keep them solvent. The problem is because of technical issues, most of these incentives go to miners. So in B.Protocol, we present a new layer 1 protocol where we take the role of the miners and give it to a smart contract. And this way, we are able to directly give these incentives to liquidators, who in turn share it with the users. So it's like win-win all over.
Got it. Cool. And the nature of this particular panel is obviously about hedging risk and using trustless insurance. And perhaps one of the largest events of, I don't know, the last 4 years, perhaps even the last decade or so, is the upcoming election and the uncertainty surrounding this event. To what extent do you think investors, developers, protocol managers like yourself should be worried about another Black Thursday liquidation event that we saw in March? And if you're worried about something like that, how could one prepare for an event such as that? Hugh, would you like to take that one on?
Yeah, I think probably Yaron's better for that one initially, okay. but I'll give it a quick crack. Yeah, I mean, look, it's obviously entering a period of quite a lot of volatility, and kind of I think it's more generally just understand what could happen with whatever positions you've got, what could happen to them, and as long as you make sure that you're kind of comfortable at them and comfortable with them and understand what the potential consequences are. I think that's all kind of risk management is really about. And if you're uncomfortable, exit stuff or cover your risk somehow, basically. But yeah, maybe it's more kind of into the liquidation stuff. So maybe that's Yaron, be good to jump in.
Sure. Yeah.
Yeah, thank you. So maybe let me start, with describing where I was in the last Black Thursday. So actually, a couple of months before that, I was starting to give consultations, to DeFi traders and MakerDAO keepers who actually were running it for profits. In the actual Black Thursday, I wasn't active in this area anymore, but speaking with them afterwards, so most of them tell me, oh, okay, no, so before that, we didn't make that much profit in liquidations. On actual Black Thursday, gas prices really mooned. So we just shut the boat down. And the high gas prices that they were on Black Thursday are really the low gas prices of today, comparing to today. So like the main lesson, the key lesson for me is, all these platforms must have some contingency plan where in case of extreme market conditions, they will have the go-to players that will be able to save them or at least mitigate, these events. Going forward to the next 3 months, so in a sense, DeFi situation is a bit more better and liquid, at least for the short term, because we see a lot of liquidity rising from projects like Uniswap and Karp. But this currently is mainly fueled by inflation, and it's hard to say how long-lasting it will be. So again, as a protocol, I think like the main advice or the main risk management that they should do is to come up with contingency plan. We as Backstop protocol try to make one for them. but that's a long. This is like a process that will take some time for some of them. So yeah, that's like the main lesson. And this is not very special to DeFi platforms. Platforms like BitMEX, Kraken, FTX, they all handle it, and they all have their own dedicated backstop. So this is really something DeFi platforms should also start considering.
Sure, and I guess just to kind of go off that last point, what would be the biggest difference between B.Protocol's backstop liquidity provider and something like on FTX or elsewhere?
No, so but to be honest, so B.Protocol is very much inspired by FTX and BitMEX incentives in the program. The point is that FTX is centralized, and if you want to adopt it to the DeFi world, DeFi space, so traditionally this space has lower liquidity, so it's harder to attract players to go there. So what all these DeFi platforms do, they give huge premium to attract players. So if FTX, Kraken, BitMEX, they give something like in the order of 1% premium, Compound in comparison gives something like 8%. So, okay, so you get huge premium, but the point is that currently, because it's like a free-for-all competition, most of this premium will go to miners. So now if you're a liquidator and you want to be part of the backstop, say in BitMEX or Kraken, so you know exactly how much you get, given some event will happen, and you can invest efforts in building a system. And this is both financial efforts and technical efforts, for hedging and other trading activities. And you know exactly when liquidation happens, how much you will get. However, in DeFi, currently the platforms are using it sort of, like a stop loss order where they say, okay, we just, put this limit order to the open market and hope people will take it because it's with premium. And this will work well for the small liquidations, but if now, someone needs to liquidate $10 million, even if it is with premium, you need to get prepared to it. So yeah, so that's like the maybe main difference between FTX and what the DeFi world is at. But like moving much forward when like the world will be mostly in DeFi and not FTX and alike. So our backstop program, it's more transparent than FTX and BitMEX. So it's really not clear, how they assigned liquidations, whether all players get the same fair conditions. So this is also an issue, when traders want to onboard and become a backstop at these platforms. They are notorious, especially BitMEX, for API that goes down, potentially have different service classes to different players. So putting everything on blockchain, really give rise to transparency.
Sure, yeah, and I guess to move from the macro events and things happening around the election, those kinds of things that can happen, I think it might be important for listeners and also just, I guess everyone here to redefine what we mean by insurance, because from what I understand, Nexus Mutual doesn't technically offer insurance, it's cover. And maybe you could kind of go into detail a little bit about what that cover is. It's not necessarily hurricane insurance, it's a very specific kind of insurance, if we want to use that word.
Yeah, so Nexus provides smart contract cover. So basically the risk of the smart contracts doing something different to what they were kind of designed to do, and you lose money as a result of that. So the kind of obvious examples from the past, like the DAO hack or the parity multi-sig wallet issues, or and more recently some of the BZX events, which we pay some claims on, etc. And so I guess the technical difference is that there's no contractual obligation for Nexus Mutual to pay claims, and therefore it's not a legal contract of insurance. It's basically up to the member's discretion. So what we're offering is what's called discretionary cover, and so that allows us to a bit more flexibility in terms of the regulatory space, because we're not regulated as an insurance contract, but it also means we can expand into different markets and stuff like that. So you don't have that legal backstop of an insurance contract if something was to go wrong, but it does give us flexibility and the ability to offer a community-based solution. So and I guess one of the other interesting things is, and that that applies to discretionary mutuals, and these things actually operate in the real world today, is that the discretion cuts both ways. So you can pay claims even if they don't actually technically meet the requirements, because the members feel like they should have paid the claim for whatever reason. So you can, it does work both ways. And so there's definitely instances of that happening. So yeah, that's kind of what we're doing right now. And I guess Nexus is also looking to expand into to other products, also expand our coverage beyond just the technical risk of the smart contract failing, looking at more other wider risks of protocols failing, and some interesting things there, like governance attacks and other economic incentive failures and various other like Oracle failures, those types of things. So there's quite a lot of risks involved there that that we're looking to expand in and help DeFi users be more comfortable with.
Sure. Yeah. And there's $11 billion, last time I checked, locked up on DeFi. That number changes quite often, and nearly 80 million of that is in Nexus. What do you think is currently the largest problem facing DeFi? Is it still smart contract vulnerabilities, or is it something more on, I don't know, the financial engineering of many of these protocols? Where do you see the biggest risk?
Yeah, I mean, it's hard to know what the biggest risk is really, but I think smart contract risk is always going to be there. It's always going to be fundamental, and we're actually entering into this period where there's so many people wanting to deploy DeFi protocols, but there aren't enough auditors. The auditors are overwhelmed right now, and it's really hard to get audit expertise, and so I see a lot of protocols potentially launching without audits, and hopefully they do that in a more of a restricted way, like, you know, prevent certain amounts of funds being risk, or put caps on funds and stuff like that. But anyway, so I think smart contract risk is going to be there. But I think one interesting classification that I think we're going to see more of in the next little while is governance attacks, especially with all these tokens coming out, governing protocols and stuff like that. We've already seen like essentially people rug pulling from yield farming and like basically running off with the funds. But that's kind of one level of things. But I think there's going to be more concerted governance attacks, or at least kind of changing parameters when you to your advantage, if you might not want to call that an attack, but you know, at least kind of tweaking the protocol to your advantage. And given that all these governance protocols are like decentralizing to the community, and I think we're going to see a bit more of that in the future, and people coordinating to get the most out of these systems.
Sure. Yeah, I'd like to come back to that a little bit later, but I'd like to switch over to Yaron as well. Speaking of I guess smart contract vulnerability risk and the governance risk that Hugh mentioned, your focus primarily on liquidation risk in the DeFi space. Do you see that still? I mean, do you still see that to be a major risk at current? I mean, do you, with uncertainty coming up and I guess large price fluctuations, it could still happen, right?
Yeah, but you know, even if it's not a current risk, you know, I cannot predict much on the next 3 months. But you know, it's very apparent that the platforms themselves sees it a risk, and you know, as a result, offer very poor leverage ratio, right? I mean, because they have to keep from themselves, you know, this gap of, so in MakerDAO is 50% almost, in Compound is something like 20% plus, which allows you only, you know, like X2 leverage on MakerDAO, X3 leverage on Compound. I think the highest reputable one is like X5 on DYDX, where in reality, you know, they want to offer at least X20, X100. So even if it's not, you know, like a Black Thursday risk for them, it's definitely a limiting factor for these platforms. They would want to offer higher leverage, smaller collateral ratio. So yeah, I mean, it's definitely, you know, like a big problem, which will be always, you know, relevant in terms of they will want to make the backstop as best as possible in order to have a bigger leverage to their users.
So do you see, perhaps I misunderstood, but maybe do you see individual traders hedge funds or whole DeFi protocols using B.Protocol's liquidity backstop? I guess who is your user base precisely?
No, so again, this varies when we go live in 2 weeks from now. So, we build on top of MakerDAO, and it's like a completely permissionless integration. So the user base will be MakerDAO user base. We will just, give them incentives to use MakerDAO via our platform. But moving forward, like the big vision is to be like the liquidity stop shop or the backstop, for new protocols. So now we want to make a new lending platform or margin trade, and you need a backstop primitive that will handle these things. So, MakerDAO is already very established protocol. It has its own token to be like the final backstop in emergencies. But now we want to make, a new protocol. I don't know if you're Cream Finance or the rest of them, right? And you don't have these resources. And okay, so right now they go and say, we outsource it to the entire community, they will backstop for us, we'll offer some incentive. But in reality, it's like a stop loss orders in BitMEX. It's not a real backstop. So like moving forward, like the actual customers we hope will be the backstop, the lending platform themselves. We need this kind of service.
Okay. And to come back to, I guess, Hugh's point about governance attacks, would you be able to give maybe a brief example? I know we're running a little bit out of time here. A brief example of what a potential governance attack could look like in current DeFi state?
Yeah, I mean, I guess like there's often, there was one attempt, I don't know the actual details, but with Curve, like they have particular rewards that get distributed to particular pools. And then some large whales like basically put forward proposals to divert all of the rewards or a large chunk of rewards to the pools that they were using. And so, that may not necessarily be classed as like an attack as such, but it's definitely using your governance power to your specific advantage or financial advantage. And I guess a more extreme example might be, getting enough MKR tokens to change parameters in the system that would effectively could cause the whole thing to be liquidated and you could get like a whole chunk of the money, right? Like that's kind of like an extreme attack that theoretically can happen, but that's a lot harder to pull off. So I think we're going to see a lot of these things more in a spectrum and more of the first category to start with, at least, which is kind of like DAO member activism or shareholder activism in a kind of way. But I just think this type of thing is coming, and it's going to come in all shades, but you have to be careful and look out for it.
Yeah, and based on that explanation, it kind of gives this idea that, or places more prominence on the social dynamics of the real people working with each of these protocols and how they can coordinate. And do you think this is maybe what we tried to solve, or not we, I'm not a developer, but what people have tried to solve with blockchain technologies to kind of remove this social layer and reduce everything to math? Do you think that, I don't know, perhaps creating products that serve the social disasters that could potentially happen might even instigate them themselves? Just your thoughts on that.
Yeah, I mean, I'm torn between this. Like, obviously removing governance is best if you can, but if you do, then that limits your options, and you become quite inflexible. And so like it's hard to know what's the best long-term outcome, because you need to be flexible to be able to capture the market or still remain relevant, or etc. So it's definitely a balance, and I think these protocols are leaning towards more of a harder governance, as in it's basically don't change it all except for only a few things or something. And Uniswap's probably a good example that you can only really change like one thing in the protocol, or one or two things. But yeah, I think it's going to be interesting to see how the different protocols evolve along that front.
And will B.Protocol have a governance layer, Yaron?
So yeah, I mean, so B.Protocol will have some governance, because so like the two, like two major players here is we have the users on the one hand and we have the backstop on the other hand, which will eventually, will have to, I mean, users will, or like the community in general will eventually have to dictate, some preconditions for the backstop, on its strengths. commitment, and also the profit sharing, the cut or the premium it is willing to pay. So, there's this kind of trade-off that if you offer a lot of incentive, you get stronger players, but then, you pay on the maximum leverage you can obtain. So for this kind of dynamic for the long run, we expect some governance to be formed. But concretely in the coming months, so we go live without a token, and we kind of, have some preconditions for the first 6 months, which later, we will give users the ability to vote, but based on some scoring they get, which is not a token. I mean, it's non-transferable, non-tradable. So this will be kind of the genesis governance forming. And after that, they could decide how they want to move forward with governance, etc.
Sure. And when, go ahead, sorry.
No, but that to say, okay, so this is the governance, but like the core principles, meaning, governance will not have any control on user funds. Everything is built in the form that, so we go live with MakerDAO, and user, it is always guaranteed that user will get exactly the same conditions irrelevant to any future governance. So it's mainly about the profit sharing, with the liquidators. So in theory, it doesn't put anything in risk, at least until governance itself has some monetary value, maybe in the future.
Okay. And when Yaron's B.Protocol goes live in, would you say 2 weeks? Mainnet is in 2 weeks. Would Nexus Mutual offer cover for B.Protocol? How would the cover listing process go?
Yes, so as of now, we didn't submit any proposal yet, but so yeah, we are still waiting to go live for that.
Yeah, I mean, when new protocols go live, they can just get in touch. I mean, at the moment, we kind of white these things as a team just to keep it a little bit more controlled right in the early days. But in general, we're working towards a more open listing process that's kind of either governed by the community or just open, like kind of like adding a new pool on Uniswap and stuff. So so we're kind of working through that. But generally, we if people get in touch, we try and list things pretty quick.
Sure. And what could potentially be I mean, what are your biggest fears, I guess, or biggest risks that you think B.Protocol would be facing in the very early stages of its launch?
So actually in the early stages, we give this best effort backstop to the platforms. So if our liquidators fail, eventually the ultimate backstop will be MakerDAO protocol itself. So, up to smart contract bugs and stuff we might have missed, right? I mean, the user funds supposed to be at risk, supposed to be safe. So we don't, intentionally, we decided to start building on top of other platforms. So we will not have to face this risk of making user funds secure and making the system solvent. So in that regard, and we just finished an audit process. We believe the system is safe, and again, user funds are as safe as they are on MakerDAO. The only, from the user side, so the risk is very low and almost zero. The main uncertainty is what the user will get, is reward. So there, we cannot promise anything, and this really depends on the performance of the liquidators and the market conditions. But in terms of risk, the smart contract guarantees that there's no extra risk.
Got it. Cool. Well, I think that's just about all the time we have for today. But I appreciate you guys taking the time, and it's been interesting to chat about risk and the crazy world we live in these days.
Cool. Great to be here. Thanks.
Yeah. Have a good one, guys.